What's up, people? Today is Monday, October 2nd, and this is the trading recap for the week of September 25th, Monday, September 25th to Friday, September 29th. Now, I know I'm doing this recap a little later, but anyway, looking at our returns for that week, which would be this previous week, we didn't have any trades on Monday, any official trades. We didn't have any official trades for Monday, any official trades for Tuesday, any official trades for Wednesday. Thursday, we took a minus 1.125 loss. Friday, we didn't have any trades. So we haven't had any official trades that week because there's something new that I had promised the community a few months ago. So that's what I've been working on. And more information for that is coming down the pipe, so hopefully we'll launch that this week. Now, August, one thing to note, August and September are one of the worst, or ideally the two worst performing months in the market during the year. Ideally because they fall around end of summer and also beginning of the fourth quarter, so the last quarter of the year, and also they also fall at the end of the quarter three. So there's a lot of dynamics playing out during these 2 months. So long as we're profitable, and keep in mind in August was actually our highest grossing month, right? 6.5% for that month alone. So September, we're still up 2.66%. So this I tied again and again to our proper risk to reward ratio and also risk management. So even though we are taking some losses here and there, when we do have a win, it covers like 2 or 3 losses that we've already taken due to that nice risk to reward ratio. So I'm not really bothered by, again, losses are part of the game. We just have to understand and learn from them. And as I go over the trades that we took this Thursday that resulted in a loss, you'll see some of the dynamics that played out. So let us first take this gold trade. So actually, I'm sorry, the first trade we took was this US30 trade. So let me actually go here. So for this US30, and keep in mind, I'm just replaying the bars because this is after the fact. So I didn't do the recap on the day of. So there's something new I've been testing, and this is based off of our breakout scanner. So at GA Trading Club, we have like what is it, six or so indicators, 6 or 7 indicators. Now the breakout scanner is one of our indicators. The original strategy for this was on the 15-minute time frame, but there's a new strategy that I'm testing with it that we're looking for a breakout on the 5-minute time frame during the first 15 or so minutes of New York Open, right? Because we need that volatility. So here on Thursday, you can see Thursday, September 28th at 9:40. So I was looking for a sell signal to pop up. Now, we got that sell signal on US30 at close of the 9:45 p.m. 5-minute candle. So I went ahead and this was on the live session. I said I was selling US30 with a 0.75% risk and 1:2 risk to reward, 50 pips TP, 50 pips stop loss, 100 pips TP. So you can see, unfortunately, this trade just a little bit slightly into profit. Or had actually started off a little bit into drawdown, then came back slightly into profit. But unfortunately, the next candle took us out at stop loss. And US30 reversed back up, but eventually it did drop back down, I think much later in the day. Let's see. So went up. Let me just X out of this. Or maybe I'll just X out of it. And then it should reload. So this is like a big indicator with a lot of logic, so that's why sometimes once you reload it might take a while. So US30, so you can see after we got stopped out, US30 trended up a little bit, came back down much later. So that was the trade. I said 0.75% risk. So I know since this is not like the SAR strategy, since this is a new strategy, looking back, I think for this trade, maybe we reduce our risk as we learn more about it. But this is like the day before that particular entry hit. The day after, on Friday, it actually went to full TP. So I'll show you guys, like on Friday. I have something got in my eye. On Friday, And again, keep in mind we are trading in the direction of the daily bias. My daily bias for US30 has been bearish for a minute, or for a while. Bearish on gold, bearish on EU, bullish on the dollar. So if we go back here, we see on Friday same entry, and we are looking for an entry in the direction of the bias. So here Friday 9:45. So this particular entry, I think this one got faked out or something. So we go ahead and do this. 50 pips TP, 100 pips, I'm sorry, 50 pips stop loss, 100 pips TP. So you can see this one got literally faked out, and US30 came all the way back down. So I think I need to refine the entries for this. So either lower the risk, or maybe increase the stop loss. So for the previous day, Wednesday, we do the same thing. We're looking for a sell after 9:30. So you see this sell right here, it came off at 9:30 during market open. So keep in mind the strategy is looking for a sell entry the first 15 minutes or so of New York open on the 5-minute time frame. So you can see this one actually did not have any drawdown and would have gone straight into TP. Now here's the beauty of having, like, for us we use a 1:2 risk to reward. So this is the beauty of that. This one winning trade right here that went into full TP, if we won that and we lost this one that hit stop loss on Thursday, and then this one that got faked out, or the other one that got, I think I deleted it, the other one that got faked out on Friday, would be at a break even for that strategy, because the winning trade gave us a 1:2, so we risked 0.75%. We would have been up 1.5%. So on Thursday would have hit stop loss minus 0.75, so we would still have been up 0.75%. On Friday, that's the day that little fake out. If you didn't re-enter, again, you'd just be at break even for those 3 days. So that's the importance of having that. At least I normally say at least a 1:1. With a 1:1, if you lose one trade, you only need one other winning trade to be at break even. With a 1:2, if you lose one trade, you only need the next trade that's in profit to only go halfway into profit. So the higher your risk to reward ratio is, I would say the better, ideally, because if you have a losing trade, you don't need too many winning trades to get back at break even. The only thing is you need to know the instrument that you're trading, because some instruments will not give you a 1:3, a 1:10, 1:, you know, there are people who go to 1:6, 1:7 risk to reward. But depending on where your stop loss is, because remember, your stop loss is what will determine the 1:what. what. So some instruments may not go that far before retracing, some will. So you just have to know the instrument that you're trading. So anyway, so at this point during the live session, we were minus 0.75% already for the day. And then I saw this gold trade. So we had this zone right here. So this was a 1, 2, 3, 4, a quadruple sell SAR zone in the direction of daily bias, because my daily bias here for US for gold was bearish. So here I would have marked this up this way. So this is a whole zone, and what am I looking for? Looking for text. So this was a quadruple. I don't know if by then it was a quadruple, because keep in mind I'm just doing this. So again, since this is to the downside, this will be a break and continuation for a sell, and this one I'll put here quadruple. Okay, so that is it right there. So at this point it was a possible, right? Because it had not. So if we keep going, then we get, so we keep going. Okay. So for this one in particular, so this one on top wasn't, I see. So this one on top wasn't considered. That's why I was like, I don't remember quadruple. It was actually a triple, because the distance between, the reason it's a triple, so if I take this off real quick, no, I want to delete this. Okay, so look at all these lines. So you have 1, 2, 3, 4. So therefore, Some depending on how you're looking at them, they are relatively close. But remember, if you're identifying an SAR zone, the distance between the top SAR and the bottom SAR, the very top and the bottom, should be at least at about 10 pips, because keep in mind, for gold we are doing at 30 pips stop loss, so we don't want an SAR zone that's like 20 pips or 25 or whatnot, because it will be like 100% or 70-80% of our stop loss. So we want for all of them: gold, US 30, EU. US 30 you can get away with a possibly 20 pip zone, SAR zone, but for gold around 10 pips. So you can see this line that's at the top, it's a bit further from this other line. So you see, like, the distance between this line and this line here, this is a small distance compared to this line and this line. So I'll bring back that zone. So instead of that one up there, it's this one. And then, so it's actually so the quadruple is, so the quadruple is not including the one at the top, it's including this one at the bottom that was formed. So 1, 2, 3, 4. So you had this candle that broke, so that's your break candle. So at this point it changed from and this is why I need to be doing these recaps on the day of. So it changed from a possible break and continuation to an actual break and continuation. So you had this candle. Let me replay that again for you guys. So that is the zone right there. That's the identified zone. Let me get rid of this one at the bottom. I think that's like a 30-minute that was after or there. So we are trading this zone. So we need a break and continuation in that zone. So we'll see. So this candle did not break that zone. This candle opened above that zone and broke and closed above it. So that's the break candle. Then we would have wanted the next candle to continue. That's a continuation candle. So remember, the break and continuation candles have to close above or below the zone depending on the direction you're trading. So we wanted this candle to close below this zone and preferably next to the SAR. So remember, the ideal entries are when your entry candle or your confirmation candle or validation candle closes next to your SARs, because this can allow you to even have like a tighter stop loss, because the rules here is that your stop loss ideally needs to be either above the SAR zone, or at the very least above the SAR zones you're trading, or above the previous high low. Now in this instance, when I was looking at this trade, so that was it right there. So in this trade, it was both above the sell SAR zone and above the high low. So to me, this was a nice trade. We had all these SARs that should have kept gold down, and also we had the previous high, the wick of this candle, which also, remember, wicks always tell you stories. So this one is telling me that we have a bunch of sellers here. So when we started off a bit in drawdown and then went into profit, I was hoping we keep pushing down because we needed like closure below this zone in order for, or below this previous wick at the bottom, in order for gold to push down. So as we keep going, you'll see here we literally got faked out. So you see they stop hunted us 1976.8, 1970, so like a 0.2 pip stop. And then look what happened. Gold came back down and literally went back up and then came back down. So this is literally a good example of being stop hunted. But in this trade, like if you get stop hunted by these trades, don't feel bad about them, because for me this was, again, similar to the other trade from last week. For me this was an A+ setup, because you rarely find, or not really, ideally the ideal entry should be when your validation candle closes next to those SARs, because it allows you to have even if you want to lower your stop loss value, or allows you to have that nice entry where your entry is next to the SARs, because remember, SAR, stop and reverse, can be support and resistance depending on how you interpret it, but you want your entry to be next to those SARs. Now for this trade, since we are already down 0.75% from the trade we had taken for US 30 with minus 0.75%, I said for this trade, let's risk 0.375, which is half of 0.75, so that if we win this trade, we gain back the loss we had taken on US 30. Again, I do not prefer losing anything from like 1.5% for the day, because if you lose 2 trades with a 0.75% risk, you're down 1.5%. So I don't really like being close to that, so I like playing around like minus 1.125 for the day. So that's why you'll see in this month the losses we've taken are like at most minus 1.125, because once you start going higher and higher, you start digging yourself a hole. So you can see, unfortunately, I don't feel bad for this one. The only way I would have felt bad for getting faked out of this trade would be if this validation candle had closed somewhere, let's say down here, right? Because if it had closed down here, your entry, so remember, you should always ask yourself, where is your entry area relative to your SAR? So in this instance, let's say assuming this had closed down here and the entry was down here, you can see your stop loss would have been, or the entry would have been like 50% or 60% of your stop loss. So if I got faked out of such a trade, then I would have felt bad, because I would have told myself, why didn't I wait for price to retrace up like I always do? Because for me, if a validation candle closes too far away from my SARs, I will wait for some sort of retracement, and then I'll drop down to the 1 minute or 5 minute time frames and look for an entry there. But for this one, it's just one of those ones you can't win them all. As much as you can also have A+ setups, which are to you the best setups that meet all of your requirements, it doesn't mean that those A+ setups will always hit your take profit. And from then gold actually kept dropping. So this was just like one of those trades that we got stop hunted, and they kept dropping gold. And right now gold, I believe, is at 1830. So you can see where gold is. So hopefully we get more trades. So you can see relative to where we had entered the trade all the way up here, gold has been dropping. And you can see, right, these SAR zones, they are static zones, because you can see price came back to the same zone and then gave another entry, same entry here, break, continuation. This was another entry, and I think I saw this entry, but I think I was asleep, because it was actually at 10, no, Friday at 10 a.m. Yeah, so this was Friday at 10 a.m. The issue with this, so same thing, right? So I saw this trade. So this is a break, continuation. So this is the break candle, same zone, break candle, continuation candle. So your entry would have been there. However, you ask yourself, right, with a 30 pips stop loss, which is what I use on gold, and 60 pips TP. So you can see, for me, this is not a trade I would have taken, because the SARs I'm trading are all the way here. My stop loss is not even close to those SARs. So the SARs I'm trading are like 120% of my stop loss. So I saw this trade on the live session. No, we didn't have a live session on Friday, but I was trading by myself. But I saw this trade, but I wasn't willing to take that risk, because remember, at the very least, your stop loss needs to be above those SARs. So for me to increase my stop loss, I would have needed like a, what is this, like a 55 pip stop loss. And for me to have a 1:2 risk to reward, you can see I would have needed a 110 pip TP. So I mean, it would have still hit, but I wasn't I think I put an extra 0. I wasn't willing to hold gold for that long. But you can see same zone. So this SAR zones are static. You can reuse them if you want down the line, but so unfortunately we got faked out of that trade. I'm trying to get back the zone we deleted. Anyway, I don't know if it's still there. I think it was at 30, because there was another zone here. Let me go to the 30-minute. And I'm still, again, these zones are static, so I just want to make sure. Yeah, so you see this is the zone I wanted to highlight right here. It's a triple SAR on the 30-minute, because the top SAR is 1974.1, the bottom one is 1973.5, so that's like a 0.8 pip zone. So I don't want to lose that zone. But anyway, so we'll see what this week brings. Again, it's the beginning of a new month. October. So right now volatility should increase. The manipulation and stop hunting should decrease a little bit, and our SARs hopefully should keep holding. But that's pretty it. Stay tuned. I'll drop, depending on how some of this, the release of what I'm talking about or what I'm working on goes. I'll probably release a series of videos this week, if not next week when everything is ready, and we'll see, and we'll go from there. So remember, we are always looking to improve what we are doing. Just because something works does not guarantee that it's going to work throughout the market cycle or throughout the yearly cycle. So you always need to adapt to the market and see if there's any other things you can apply that can assist you in this journey. But anyway, until next time, I will catch you guys. Have an amazing trading week. Peace.